So one question that clients ask me all the time is, when I go to sell my home, will I have to pay capital gains tax on the sale? So today I'm going to break it down in a way that's easy to understand whether you're selling your home or an investment property. I'll also explain when this tax applies and when it doesn't, and if it does, what to expect. So if you're selling your primary residence, meaning the place that you actually live in, the good news is that you likely won't have to pay any capital gains tax at all. So that's because of something called the principal residence exemption. If your home was your primary residence for all of the years that you've owned it, and you report the sale on your tax return properly, you won't have to pay any tax on the profit. Even if you lived in the house only part of the time or rented out a portion of it, like a basement suite, you might still qualify for either a full or partial exemption. The key is how the property was used and whether you claimed any depreciation or used it strictly as a rental. Since 2016, the CRA requires you to report the sale of your primary residence, whether you owe taxes on it or not. A lot of people still miss this step, so be sure that it's on your radar when you do go to file. Now, if you are selling a rental property or any kind of investment property, capital gains tax will apply. Here's how it works. So if you sell a property for more than you paid for it, the gain is considered a capital gain. 50% of that is taxable, and that will get added on to your income for the year. Let's say you bought a rental condo for $400,000 and sold it for $500,000. $100,000 of that is then taxable, and what you'd actually end up paying is dependent on whatever your personal income tax bracket would be. Keep in mind that any renovations, legal fees, or realtor commissions can be deducted to reduce the gain, so make sure you track that carefully. So there are only a couple of situations in which the capital gains tax will not apply. The first being when your property fully qualifies as your primary residence. The second is if you sold your property at a loss. But if this was a personal use property, the loss isn't deductible either. One more thing to watch for is a change in use. So if you converted your property to a rental or back to personal use, the CRA treats that as if you sold the property and then bought it again. That can trigger a capital gains tax even if you haven't actually sold it, unless you file a specific form to defer the tax. So to sum up, if you are selling a property and it qualifies as your personal residence, you're in the clear. If it's an investment property or a flip, expect to pay tax on half the profit. And if there's been a change in how the property is used, definitely get advice before listing. A little planning here can save you a lot of money later. If you found this helpful, feel free to check out the full blog post about this on my website. I have some extra details there that could be helpful to you, especially if you're thinking about selling a rental or income property. And if you're planning to sell and want help figuring out what your next step should be, I'm always happy to chat. Thanks for watching, and I will see you in the next one.